Have you ever spent countless hours analyzing charts, studying indicators and researching market patterns only to find yourself still losing money? It's one of the most frustrating experiences in trading, isn't it? That moment when you realize all your effort isn't translating into consistent profits. You're not alone in this struggle, and today I'm going to reveal what's really holding you back from trading success. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the globe. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Let's get right into it. What if I told you that the market doesn't actually reward effort? It's a shocking truth that many traders never fully grasp. You can sit in front of your screens for 12 hours a day, 7 days a week, and still blow up your account if you're missing the fundamental principle that Richard Wyckoff discovered decades ago. The market rewards discipline, not hard work. Has this ever happened to you? You've done all your homework, analyzed every indicator, convinced yourself you found the perfect setup, only to watch your trade crumble before your eyes. The problem isn't your analysis, it's your approach to the game itself. Success in trading doesn't come from trading more, it comes from trading right. Here's something that might surprise you. Having a high win rate doesn't guarantee consistent profits. I've seen traders boasting about winning 80% or even 90% of their trades, yet they're still struggling financially. How is that possible? Because when the market decides to punish you, it can wipe out months of small gains in a single catastrophic loss. The market doesn't care about how often you win. It only cares about how much capital you preserve when you're wrong. This is the arithmetic that most traders refuse to face. They're looking for excitement, the thrill of being right, instead of focusing on the only metric that truly matters, your bottom line at the end of the month. Ask yourself honestly, are you trading to be entertained or are you trading to make money? Stay with me until the end of this video because I'm going to walk you through the exact principles that separate professional traders from amateurs. These aren't flashy strategies or complicated systems. They're the foundational truths about market behavior and psychological discipline that will transform your approach to trading. The difference between mediocre results and consistent profitability isn't found in some secret indicator or pattern recognition skill. It's found in understanding market temperament and developing the discipline to respond appropriately. The market has moods just like people do, sometimes patient, sometimes furious. And if you don't learn to read and respect these moods, you'll find yourself constantly swimming against the current. This hidden truth has transformed the trading journey of countless professionals who've learned to adapt their approach based on what the market is telling them, not what they want the market to do. If you found value in these trading principles, hit that subscribe button to join our community of disciplined traders focused on consistent results rather than quick wins. Think about it this way. Would you use the same communication style with someone who's relaxed versus someone who's anxious or agitated? Of course not. Your natural emotional intelligence would guide you to adjust your approach. Trading requires this same level of awareness. When the market is patient, consolidating in a tight range, you need different tactics than when it's making furious, volatile moves. This mindset shift is where the real breakthrough happens. Instead of imposing your will on the market, a battle you're destined to lose. You learn to become an observer first. You watch the price action unfold, notice the subtle changes in momentum, and then align your decisions with what's actually happening, not what you hope will happen. And here's a revelation that might feel uncomfortable at first. Prices are never wrong. Your opinion can be. The tape never lies. It's simply reflecting the collective decisions of all market participants at that moment. When you find yourself arguing with the market, insisting that a move shouldn't be happening, you've already lost the plot. I remember a painful lesson early in my trading career. I was convinced a stock was undervalued and kept averaging down as it fell, believing the market would eventually see things my way. It didn't. That expensive education taught me something priceless. When the market tells you you're wrong, the only rational response is to listen, cut your losses, and move on. This is the fundamental difference between amateur traders and professionals. Amateurs stake their identity on being right. They take losses personally, as if the market is somehow out to get them. Professionals understand that consistency isn't about always being right. It's about doing the right thing after you're wrong. Behind the scenes of every successful trading career is a long history of small, well-managed losses. That's the paradox that few understand. Your ability to take small losses gracefully is what ultimately leads to big profits. It's not about avoiding being wrong. It's about ensuring that when you are wrong, and you will be, it doesn't impact your ability to continue trading tomorrow. Now, I want to go even deeper into this topic by exploring how successful traders manage their winners and losers properly. Because there's a counterintuitive approach here that completely transforms your results when you embrace it. If you're finding these principles resonate with your own trading experiences, write in the comments, price. Action speaks louder than opinions. I'd love to hear about your own journey with this concept. The most profound revelation that transformed my trading journey came when I realized that improving my win rate wasn't about finding better indicators or more complex strategies. It was something far simpler, yet psychologically challenging, cutting my losing trades faster and letting my winning trades run longer. This principle sounds straightforward, but it's astonishing how many traders do exactly the opposite. They nurse their losses, hoping for recovery, while they strangle their profits by taking them too quickly. Think about your own trading decisions for a moment. Have you ever held on to a losing position, watching it drift deeper into the red, while telling yourself, "It'll come back, I just need to be patient"? And in contrast, have you ever closed a winning trade at the first sign of profit, only to watch in frustration as the move continued without you? This behavioral pattern is so common because it's wired into our psychology. We avoid pain and seek immediate gratification. The mindset shift required here is fundamental. When you enter a trade that immediately goes against you, it's not telling you to be more patient. It's giving you valuable feedback that your timing or analysis was off. The market is speaking to you through price action, and your decision to quickly exit with a small loss isn't a failure. It's a strategic choice to preserve your capital for better opportunities. On the flip side, when a trade moves in your favor, that's when your patience becomes your greatest asset. Behind the scenes of every significant trading fortune is the discipline to let winners run. Richard Wyckoff understood this principle deeply. He knew that the big money isn't made in the getting in, it's made in the sitting tight when you're right. And this leads us to another counterintuitive truth that separates professional traders from amateurs: trading less, not more. In a world obsessed with action and constant engagement, this wisdom feels almost rebellious. The amateur believes that more trades mean more opportunities, more chances to win. But the seasoned professional understands that more trades actually mean more exposure to mistakes, more commission costs, and more emotional drain. The journey to mastery in trading often involves a gradual reduction in trading frequency, not an increase. I've watched countless traders evolve from overtrading to becoming selectively patient, waiting for only those setups where multiple factors align in their favor. The revelation here is that the best trading opportunities don't present themselves daily. Sometimes you might wait a week, sometimes a month, for that perfect alignment of conditions. This patience is a form of power. When you're not compelled to trade by boredom or the fear of missing out, you develop a clarity that the frantically active trader never experiences. You begin to see the market's rhythm more objectively, and your entries become more precise, your management more confident. Let's be honest, this approach demands a significant shift in how we relate to the markets. It requires us to value quality over quantity, patience over action, and disciplined execution over emotional impulse. But the impact on your trading results can be transformative. And speaking of transformation, this strategy pairs perfectly with what I'm about to explain about simplicity in trading, systems, and how complexity often becomes the enemy of consistency. If you've struggled with taking losses quickly while letting your winners run, write in the comments, "I'm learning to reverse my instincts." I'd love to know which side of this equation is more challenging for you. One of the most liberating discoveries in my trading journey was that simplicity breeds consistency. When I first started, I thought sophisticated trading meant having charts that looked like Christmas trees. Multiple indicators, trend lines crisscrossing everywhere, alerts popping up constantly. I was convinced that more information would lead to better decisions. What a profound misconception that turned out to be. Behind the scenes of successful trading, you'll find an almost austere approach to analysis. The revelation that changed everything for me was understanding that the fewer moving parts in your trading system, the fewer things can go wrong. Every additional indicator, every extra rule or filter doesn't just add complexity, it multiplies the opportunities for confusion, second-guessing, and inconsistent execution. Richard Wyckoff understood this principle deeply. His approach focused on clean price action, volume analysis, and market structure, the core elements that truly drive market movement. When you strip away the noise and focus on these essential components, a remarkable clarity emerges. You begin to see the market's language more purely, without the distortion of excessive indicators that often contradict each other. Think about the most impactful decisions in your life. Were they made in moments of overwhelming complexity or in moments of clarity? Trading follows this same pattern. One or two good indicators that you truly understand, combined with clean price action analysis and disciplined execution. That's all you need. This simplification isn't about dumbing down your approach, it's about distilling it to its most powerful essence. But here's where many traders encounter a roadblock on their path to consistency. They discover a simple, effective approach, but still fail to implement it successfully. Why? Because no technique, no matter how refined, can save you from a weak trading temperament. This brings us to perhaps the most crucial aspect of trading mastery, your mindset. The market doesn't just test your analytical skills, it tests your nerve. It reveals with brutal honesty how patient or impulsive you truly are. It exposes whether you can follow your own rules when emotions are running high. I've seen brilliant analysts fail as traders because they couldn't execute their own perfect setups when real money was on the line. This psychological dimension is where the true battlefield of trading exists. You cannot achieve consistency if you're trading from emotion instead of following your plan. Think about it. Have you ever had a perfect setup, one that checked all your boxes, but you hesitated to take it? Or have you jumped into a trade that broke all your rules just because you were feeling FOMO? These moments reveal the gap between knowing what to do and actually doing it when it matters. The transformation required here is profound and deeply personal. It's about developing a relationship with uncertainty and risk that doesn't trigger your fight or flight response. It's about cultivating a mindset where you can be wrong without it affecting your self-worth, where you can take a loss without it clouding your judgment for the next opportunity. What's fascinating is how these first principles we've discussed, from market temperament to simplicity to mindset, all interconnect to create a foundation for consistent performance. And as we explore the importance of establishing reliable routines in your trading, you'll see how these elements come together in daily practice. If you've experienced that moment of clarity when you simplified your approach and saw better results, write in the comments, "Less is more in my trading." I'm curious how many of you have discovered this counterintuitive truth already. The hidden pattern behind consistent trading performance often goes unnoticed because it seems too ordinary, routine. While many traders chase the excitement of new strategies or breakthrough indicators, the professionals understand that consistency comes from the seemingly mundane practice of daily habits. These routines act as anchors, keeping you grounded regardless of market volatility or your recent performance. When I studied the journeys of elite traders, I discovered they all shared this commitment to structured routine. They wake up at the same time each day, follow a specific pre-market ritual, scan the same tickers in the same order, and record every trade with meticulous detail. This methodical approach isn't about being rigid. It's about creating an environment where your decision-making can flourish without the interference of chaos. The revelation that transformed my own trading was implementing a comprehensive trading journal, but not the surface-level kind that only tracks entries and exits. A truly powerful journal documents your mental state during each trade. Were you calm or anxious, confident or uncertain, disciplined or impulsive? Over time, these psychological notes reveal patterns that no technical analysis ever could. You begin to see the invisible correlation between your internal state and your external results. Richard Wyckoff himself was known to sit with a notepad beside his ticker tape, recording not just price movements, but his observations and thought processes. He wasn't trying to predict the market, he was training his mind to understand it more deeply. This practice built his intuition to the point where he could sense when a move was genuine or false, a skill that goes far beyond what any indicator can provide. Now, let's address perhaps the most challenging discipline in trading, one that separates the professionals from everyone else, learning when not to trade. This might sound counterintuitive in a world that celebrates action, but the hardest part of trading isn't executing positions, it's waiting patiently for the right conditions. Most traders lose money not because they lack knowledge, but because they can't stay out of the market when conditions are unclear. They'd rather trade noise than sit in silence. This compulsion to always be in the game comes from a fundamental misunderstanding of how markets work. The market doesn't present high-probability opportunities every hour or even every day. Sometimes the smartest decision is to do nothing, to preserve your capital and your mental energy for when genuine opportunities emerge. Subscribe to continue this journey of trading mastery with me. I share insights like these that go beyond technical indicators to help you develop the mindset of a professional trader. Behind the scenes of every successful trading career is the wisdom to recognize that doing nothing is still a decision. It's an active choice that requires discipline and confidence. The market rewards this patience in ways that most traders never experience because they're too busy forcing trades in suboptimal conditions. I've found that this waiting game becomes easier when you shift your perspective from seeing trading as a series of individual bets to viewing it as a long-term business. This brings us to a powerful framework that will elevate your approach to an entirely different level, treating your trading with the same strategic rigor that a CEO applies to running a successful company. If you've experienced that moment when staying out of the market saved you from what would have been a losing trade, write in the comments, "Patience saved my capital." I'm curious how many of you have discovered the power of strategic inaction. The moment that truly revolutionized my trading journey came when I stopped seeing myself as a trader and started thinking like a CEO. This perspective shift transforms everything. Until you handle your trades with the same strategic discipline that a business owner handles inventory or costs, you'll never see consistent profits. Think about it. Would a successful restaurant owner make decisions based on emotions, hunches, or the thrill of taking risks? Absolutely not. In this business framework, your capital is your inventory, your losses are expenses, and your product is disciplined execution. Most people enter the markets with a gambler's mindset, chasing the emotional high of being right instead of focusing on the bottom line results. They treat trading like a casino game rather than a strategic enterprise that requires planning, analysis, and accountability. When you embrace the trading as a business mindset, you begin to think in terms of process rather than luck. You develop systems for your entries, exits, risk management, and capital allocation. You stop obsessing over individual trades and start focusing on your performance over a series of 100 trades. Just as no business measures success on a single sale, a trader shouldn't judge their approach based on one position. Behind the scenes of every sustainable trading operation is strict expense control. In trading terms, that means disciplined stop losses. When a trade goes wrong, that loss becomes simply the cost of doing business. You record it, learn from it, and move forward without emotional baggage. No legitimate business throws more money at a failing product line just to justify the initial investment. Yet traders do this constantly when they average down on losing positions. This business perspective naturally leads us to what I consider the most undervalued asset in trading: emotional control. Here's the revelation that changed everything for me. Your true edge in this game is psychological, not technical. You can master every indicator, memorize every chart pattern, and still fail if you can't master your emotional responses. The market doesn't test your intelligence, it tests your temperament. Every price tick, every false breakout, every unexpected news announcement is essentially a psychological test designed to pull on your emotions: fear, greed, impatience, and hope. These emotions are what the market feeds on. They're the invisible drivers behind price movement, creating the opportunities that disciplined traders exploit. Most traders believe their edge comes from finding a better system or indicator, but your real competitive advantage is your ability to execute with calm precision when others are reacting emotionally. The chart doesn't care about your hopes or fears, it only reflects the collective emotions of all participants back at you. That's why the same setup that makes one trader rich can destroy another. It's not the method, it's the mind behind it. When you watch price action, you're really watching a mirror of mass psychology. Greed rushing in, fear pulling out, panic, euphoria, hesitation. Your job is to recognize these patterns without becoming part of them. The journey to emotional mastery in trading parallels the personal development work that transforms other areas of life as well. It requires self-awareness, honesty about your triggers, and the courage to face uncomfortable truths about how your psychology impacts your decision-making. If you've had that light bulb moment where you realized your trading results were more about your psychology than your strategy, write in the comments, "My mindset is my edge." I'd love to hear about your own experiences with the psychological side of trading. Let's delve deeper into what emotional control really means in trading. There's a common misconception that mastering your emotions requires becoming some kind of trading robot, devoid of feelings, mechanically executing your plan. Nothing could be further from the truth. Emotional control doesn't mean suppressing your feelings. It means understanding them deeply enough that they inform your decisions rather than dictate them. Fear, for instance, is a natural response to uncertainty and risk. You can't pretend it isn't there when you're about to enter a trade or when the market moves against your position. The breakthrough comes when you acknowledge that fear without allowing it to hijack your decision-making process. It's about creating a space between the emotion and your response, a moment of awareness where you can choose your action rather than react instinctively. I remember a pivotal moment in my own journey when I realized I was constantly seeking comfort in my trading decisions rather than following my carefully designed plan. Comfort seeking led me to take profits too early, avoid perfectly valid setups that made me nervous, and break my own rules when they felt inconvenient. The disciplined trader, however, waits for their plan to confirm, not for their emotions to feel settled. This revelation fundamentally shifted my relationship with trading. I stopped trying to fight my emotions and instead became curious about them. What was this anxiety telling me? Was it highlighting an actual flaw in my analysis, or was it simply the natural discomfort that comes with uncertainty? This inner dialogue became as valuable as any technical analysis I performed. Behind the scenes of every consistently profitable trader is this same emotional awareness, the ability to feel fear, excitement, or doubt without being controlled by them. It's a skill that transcends trading and touches every aspect of decision-making in life. The composure you develop through trading becomes a lens through which you view all challenges. Now, let's connect this emotional mastery to what might be the most countercultural principle in trading: prioritizing capital preservation above all else. While everyone talks about making money, professionals obsess over not losing it. This distinction represents a profound perspective shift that separates those who last in this game from those who flame out quickly. The hidden truth is that if your capital disappears, the game ends. You can't recover from zero. No strategy, no indicator, no analysis technique matters if you don't have funds to deploy. The market presents opportunities every single day, but only to those who still have capital to participate. This reality forces a complete reordering of priorities. Professionals chase preservation first, not profits. They're like skilled martial artists who understand that surviving the fight is the prerequisite to winning it. This mindset manifests in their position sizing, their willingness to stay in cash during unclear conditions, and their almost religious adherence to stop losses. It's not exciting or glamorous, it's methodical, disciplined, and ultimately transformative. The journey toward becoming preservation-focused requires confronting the ego's attachment to being right and making money. In Quickly, it means embracing the paradox that to make more, you must first risk less. This principle connects deeply with risk management and the humility required to truly respect the markets. If you've experienced that moment when saying no to a questionable trade felt more empowering than saying yes to a good one, write in the comments, "Preservation before profits." I'm curious how many of you have already discovered this counterintuitive principle. Building on our foundation of capital preservation, let's explore what truly makes it possible: risk management paired with genuine humility. This combination forms the protective shield that allows traders to survive long enough to thrive. Capital protection isn't just a theoretical concept. It manifests in the practical decisions you make before entering any position. The revelation that transformed my approach was realizing that risk management starts with humility, the honest acceptance that I can be wrong often, repeatedly, and sometimes in ways I never anticipated. The market doesn't reward ego. Every trader who believes they're smarter than the market eventually learns this lesson the hard way. The tape always gets the final word. This humility isn't weakness, it's strategic wisdom. It leads you to define your risk before you even consider your reward. Before entering any position, you decide, not emotionally, but mathematically, exactly how much you can afford to lose if the trade goes against you. Your emotions will inevitably fluctuate during a trade, but these predefined parameters remain constant, creating a safety net for your decision-making. Think about your own approach for a moment. Do you consistently determine your exit point before entering a trade? Or do you, like many traders, focus primarily on how much you might make, leaving the risk side undefined? This simple shift, defining risk first, creates a profound transformation in both your results and your psychological relationship with trading. Every dollar you don't lose compounds just as powerfully as every dollar you gain. That's the hidden truth that flashy trading gurus rarely emphasize. While everyone loves discussing spectacular wins, the journey to consistent profitability is actually paved with small, controlled losses and protected capital. Now, I want to go even deeper into what might be the most counterintuitive principle in trading: the understanding that observation is infinitely more powerful than prediction. Every trader initially wants to know what's going to happen next, where prices will move, when breakouts will occur, how far trends will run. This predictive mindset feels natural, but actually creates a fundamental weakness in your trading approach. The breakthrough comes when you realize that prediction is the weakest part of trading, while observation is the strongest. The traders who last aren't those trying to forecast every tick. They're the ones who learn to watch the market patiently until it reveals its rhythm. The tape always tells the truth to those who listen long enough without imposing their biases. This observational approach represents a complete paradigm shift. Instead of saying, "I know what will happen," which is ego, you adopt the mindset of, "I'll wait and see what's happening right now," which is humility. When you watch without preconceptions, when you stop trying to prove yourself right, you begin to see patterns others miss. How volume swells quietly before significant moves. How price behaves differently before a breakout versus a fake out. These subtle signals are everywhere, hiding in plain sight, but they're only visible to those who have developed the patience and clarity to recognize them. That's because charts aren't just technical formations, they're visual representations of human emotions plotted across time. Fear, greed, uncertainty, and conviction all leave their fingerprints on the tape for those who know how to interpret them. If you've had that moment when you stopped trying to predict what the market should do and instead simply observed what it was actually doing, write in the comments, "I watch, then I act." I'm curious how many of you have experienced this fundamental shift in perspective. As we wrap up today's exploration of trading principles, I hope you've found these insights as transformative as they've been in my own journey. What Richard Wyckoff understood decades ago remains profoundly relevant today. This game isn't about predicting the future or finding magical indicators. It's about disciplined observation, emotional mastery, and treating your trading with the seriousness of a business. The principles we've discussed, from simplifying your approach to prioritizing capital preservation, aren't just trading concepts. They're a framework for decision-making that transcends the markets and touches every aspect of how we navigate uncertainty in life. That's the beauty of trading when approached correctly. It becomes a mirror reflecting our relationship with risk, patience, and self-mastery. If you've resonated with these ideas and want to continue growing as a trader, I'd love to have you join our community. Subscribe to the channel, where we dive deep into these principles every week, breaking down the psychological and technical elements that lead to consistent results. Each video builds on these foundational concepts, creating a comprehensive approach to the markets. If this message spoke directly to you today, drop a comment saying "The tape never lies." I read every comment and would love to hear which principle resonated most deeply with your own trading experience. And if you found value in today's insights, hitting that like button helps tremendously in sharing these ideas with others on the same path. I've put together a video right here that expands on the concept of risk management we touched on today, examining exactly how professionals size their positions to protect capital while maximizing returns. Click and join me there as we continue building your trading framework one principle at a time.